You know that feeling when you finally buy something you have been watching for weeks, and the second you click confirm, the price drops. Not a little drop either, like a real gut punch drop. Suddenly you are sitting there thinking, did I just time this completely wrong? Now take that exact feeling and scale it up to your entire Bitcoin position. Same emotion, just with more zeros attached. You bought into the story when everything looked perfect. ETFs are approved, institutions are buying, big names are talking about adoption, and it finally feels like the world is catching up. You are not early anymore, you are validated. And then nothing happens. Or worse, price chops around or drops. No explosive move. No to the moon. Just uncertainty. And that is where the real question starts forming. If everything you are seeing in the news says adoption is accelerating, if institutions are supposedly accumulating, if scarcity has not changed at all, then why is the price not reflecting that? Why are we not at $150,000 or $200,000? What is actually holding this thing back? Because there is a moment every investor hits in markets like this where the narrative and the price stop agreeing with each other. And that gap, that uncomfortable space between what should be happening and what is happening, is where most people either panic or start looking deeper. This is not about conspiracy theories. It is not about secret groups controlling markets or shadow manipulation. It is about something far more boring and far more powerful: incentives, structure, and pressure. Because once you understand how modern financial systems actually behave under stress, you stop thinking in terms of someone is pushing the price down and start thinking in terms of what structures create forced behavior when conditions change. Let me show you what I mean with something completely unrelated at first glance. Back in the 1980s, countries like Mexico borrowed massive amounts of money in US dollars. Not in their own currency, in dollars. And that detail is everything. Because when you owe debt in a currency you do not control, you do not have the ability to fix the problem internally. You cannot print your way out. You cannot reset it. You are dependent on external conditions. So when interest rates in the United States went up, something brutal happened. Their debt payments exploded overnight. Their own currency weakened. Their revenues could not keep up. And suddenly, they were trapped in what economists call a debt spiral. The more they tried to manage it, the more constrained they became. Eventually, they had to restructure their economy, cut spending, sell assets, and open themselves up to external control. And here is the key idea. Nothing illegal happened. There was no attack. It was just structure meeting pressure. Debt spirals do not just happen to countries. They happen to companies. And in modern markets, companies can become highly leveraged in very sophisticated ways that most people do not fully appreciate until something goes wrong. Right now, one of the most important players in Bitcoin is not a miner, or an exchange, or even an ETF. It is a company called MicroStrategy. On paper, they are a software company. In reality, they have become something closer to a leveraged Bitcoin holding structure wrapped inside a publicly traded stock. And that distinction matters more than most people realize. MicroStrategy did not just buy Bitcoin with cash. They built their position using a mix of equity issuance, convertible bonds, and preferred shares. That means they did not just invest, they created obligations. Payments that must be made regardless of what Bitcoin does next. Interest payments. Dividend payments. Financial commitments that do not care about sentiment or narratives. So now you have a structure where one asset, Bitcoin, is being held inside a company that also carries financial pressure. And that pressure does not disappear just because the long-term thesis is strong. MicroStrategy's entire strategy depends on something very specific. Their stock trading at a premium to the value of their Bitcoin holdings. That premium is what allows them to raise money by selling shares, which they then use to buy more Bitcoin, which in turn strengthens the narrative, which pushes the stock higher, which allows them to raise more money. It is a flywheel. And when flywheels work, they look unstoppable. But flywheels do not break gradually. They break when one condition changes. So ask yourself, What happens if the market stops paying that premium? What happens if investors decide the stock is no longer worth more than the underlying Bitcoin it holds? Suddenly, the entire mechanism changes. They cannot raise capital the same way anymore. Issuing new shares becomes inefficient, or even destructive. The loop that was funding accumulation starts to slow down. But the obligations do not slow down with it. Debt still exists. Dividends still exist. Payments still need to be made. And now the only real source of liquidity left, in a worst-case scenario, is the asset itself, Bitcoin. This is where people jump to extremes and miss the nuance. Because this does not mean they are going to dump everything. It means that in stressed conditions, forced behavior becomes possible. And markets price in the possibility of forced behavior long before it actually happens. That is the key to understanding why price sometimes feels disconnected from narrative. Because markets do not just price what is happening. They price what might be forced to happen under stress. Now take this one step further. If you were a large institutional player, and you understood that a major holder of Bitcoin was structurally sensitive to price and liquidity conditions, would you prefer to buy Bitcoin at $100,000? Or would you prefer to create conditions where it trades at $80,000? You do not need illegal coordination. You do not need manipulation in the traditional sense. You just need to understand that when certain assets or companies are structurally vulnerable, price movement itself can create opportunity. Short selling, for example, is not inherently malicious, but it does create directional pressure. And when enough participants are positioned the same way, price action can reinforce itself. This is important because it changes how you interpret volatility. When Bitcoin drops sharply, most retail investors interpret it as information. Something must be wrong. The thesis must be breaking. I should reassess everything. But sophisticated investors often ask a different question entirely. Is this drop caused by fundamentals changing, or is it caused by positioning and structure adjusting under pressure? Because those are two very different situations. One requires you to rethink your thesis. The other requires you to hold it, or even increase exposure. And this is where most wealth transfers happen in markets. Not through perfect timing, not through prediction, but through emotional response to structural events that feel like information, but often are not. Imagine you buy Bitcoin at $100,000. It drops to $85,000. You are down 15%. It feels real. It feels like you made a mistake. Every instinct tells you to do something. Reduce risk, protect capital, step aside. Now imagine instead that this drop was not caused by a collapse in adoption or fundamentals. Instead, it was caused by liquidity stress, leveraged positioning, or structural unwinding somewhere in the system. In that case, nothing about Bitcoin's long-term thesis has actually changed. But your behavior might change anyway. And that gap between unchanged fundamentals and changed behavior is where markets move wealth from impatient to patient participants. Now, zoom out even further. Think about what institutions actually want. They do not need Bitcoin to fail. They do not even need it to be weak long-term. In fact, many of them are increasingly aligned with its long-term success. What they often want, what any rational allocator wants, is better pricing. More favorable entry points, reduced cost basis. And markets, especially ones as liquid and emotionally driven as crypto, tend to provide those opportunities during moments of stress. Stress creates liquidity. Liquidity creates price dislocations. Price dislocations create opportunity. But only for people who can recognize what kind of environment they are in. None of this guarantees anything about Bitcoin's future price. It does not say where it is going next week, next month, or even next year. What it does do is change how you interpret what you are already seeing. Because once you understand that price is not just a reflection of narrative, but also a reflection of structure, leverage, and positioning, you stop reacting to every move as if it is a verdict. You start seeing it as data. And that changes everything about how you behave during volatility. So the real question is not, why is Bitcoin not higher right now? The real question is, what conditions are currently influencing price behavior beneath the surface? And how should a long-term investor respond when those conditions create noise? Because in the long run, markets do not reward the people who react the fastest. They reward the people who understand what is actually happening when everyone else is focused on the wrong layer. And if you can learn to separate narrative from structure and structure from emotion, you stop being a participant in short-term noise and start becoming someone who understands why that noise exists in the first place.